Hello everyone, and welcome to those who have joined us via the CEDA live stream for today's event, Strength and Resilience in the Australian Financial System. My name is Melissa Wilson and I'm Senior Economist here at CEDA. CEDA acknowledges that today and every day we are on Aboriginal land. Committed to recognition and reconciliation, we respect elders and we support their stated aspirations. As we reflect on the strength and resilience of the financial system today, it is important that we remember that the broader purpose of a strong financial system is to enhance the economic security and welfare of all Australians. Aboriginal and Torres Strait Islander people experience some of the highest rates of financial insecurity in our community, so it is important that we work together to improve financial inclusion for all First Nations people. The financial system entered the COVID period in a position of strength, with substantial capital buffers and strong profits. This strength enabled financial institutions to not only withstand the crisis shock, but to also play a critical role in Australia's COVID response, offering loan repayment deferrals, providing early access to superannuation, and facilitating government payments to businesses and households. So far, the better-than-expected recovery has helped to reinforce the stability of the financial system, and looking further ahead, financial institutions will continue to play a critical role in responding to the risks and opportunities that will shape our future. We look forward to hearing more about some of these risks and opportunities today. I'd like to thank our major sponsor, Gilbert and Tobin, for their support of today's event. CEDA's work is not possible without the help of our members, and we are truly grateful for your support. CEDA's members are also essential to delivering on our purpose of pursuing better economic and social outcomes for the greater good. Your input is important, so please join in today's conversation on Twitter by using the hashtag APRA and tagging @CEDA_news. You can also ask questions via the Pigeonhole app. The URL is ceda.pigeonhole.at, and the password for today's event is APRA. So now, to commence today's event, I'm delighted to introduce Gina Cass-Gottlieb, Senior Partner in Competition and Regulation at Gilbert and Tobin, to make some opening comments.
Thanks very much, Melissa. Good afternoon to everyone, to Wayne and Paula from APRA, to CEDA executive and members, and to everyone present. Firstly, I personally, and on behalf of Gilbert and Tobin, want to acknowledge the Gadigal people of the Eora Nation, the traditional custodians of this land, and to pay our respects to them, their culture, and their elders past, present and future. The last 12 months have provided yet another test of Australia's prudential regulation, in some ways perhaps the most acute since APRA's inception in 1998. Given the extraordinary events of the past year, this is an opportune time to reflect, together with Wayne, on APRA's purpose, its achievements in 2020, which were formidable, and what we can look forward to in 2021. APRA's mandate has always required it to balance multiple, as we see with many federal regulators, at times competing objectives. Under the APRA Act, APRA must balance the objectives of financial safety and efficiency on the one hand, with those of competition, contestability and competitive neutrality on the other, and in balancing these two, to promote critically financial system stability in Australia. APRA doesn't carry this role, very important role, alone in Australia's regulatory landscape. It plays what is often an unenviable and highly scrutinised role and makes a critical contribution to promote the country's financial well-being together with the RBA, ASIC and the ACCC. It's not an easy role and requires, led by its senior staff, constant evaluation of priorities and strategy. We are all aware that in the last 22 years, APRA has faced some well-recognised challenges in meeting this mandate. In 2003, it was part of the subject of the report of the Royal Commission into the collapse of HIH insurance. A few years later, it played a critical role in steering our financial system through the GFC. In 2019, there was further examination with the release of the Financial Services Royal Commission report and Treasury's capability review, with a range of recommendations relating to APRA. Through all of these challenges, however, it's my view, and I think we would all agree, that there's widespread acceptance that APRA has been and continues to be a very successful regulator. As the capability review noted, there have been very few failures of notable financial institutions and no systemic financial crisis in Australia, a rare track record globally, and APRA, its chair and its staff are well respected amongst its domestic and global peers and the financial sector more broadly. As we reflect on the last 12 months, APRA is to be congratulated for its response to the COVID-19 pandemic. A number of these aspects were referred to by Melissa in her opening remarks. The nature of the crisis faced by the economy, and if we would think back to this time last year with the cry of what had previously not been a policy priority, namely directed to flattening the curve, that well-known phrase, was very far from the minds of business, government, regulators, policymakers in 2019. The nature and extent of the social and economic restrictions the community personally, businesses, governments, regulators faced had not been experienced in our living memory, though perhaps in the generations in our grandparents' memory. In March 2020, APRA decided to grant temporary capital treatment to banks and other ADIs to enable them to provide repayment deferrals to residential mortgage and small business customers. Under the capital treatment, banks did not need to treat the deferral period as a period of arrears, and loans did not have to be regarded as impaired or restructured. In that period, according to the data available on the Australian Banking Association website, banks had deferred over 779,000 loans with a total value of $236 billion. In July 2020, responding to its various somewhat conflicting objectives, APRA moved to update its temporary capital treatment to facilitate banks and other ADIs, returning COVID-19 impacted borrowers to a more sustainable financial position than an absolute deferral, while ensuring continuing systemic stability. The latest loan deferral figures from the banks reflect this transition, that, as seen on the ABA's website, reveal that at the end of February 2021, just under 97% of all loans that were deferred were back on track, and that the total value of loans deferred has dropped from $245 billion by the final figure to $10 billion. So APRA's practical, quick, very engaged with its supervised entities, decisive response enabled banks to support customers through what was anticipated to be the very worst of times. In addition, during this period, recognising that maintaining access to credit was critical to the economy, APRA chose to allow banks to rely where needed on the capital buffers that Melissa referred to that had been built up over the preceding years in order to facilitate continued lending. These types of unthinkable scenarios, so for the institutions here who plan for various risk events and scenarios, an unthinkable scenario are at the core of why effective prudential regulation is so important. 2020 was a test of whether our system of prudential regulation, designed and supervised by APRA, had achieved its primary purpose: to deliver and maintain a resilient financial system able to withstand and absorb the impacts even of an unforeseen severe crisis. Had our banks, superannuation funds and insurers been unable to cope and respond, the impact would have been far more severe on our economy. As Melissa was noting, the system met the most acute of tests. APRA also, in its priorities, gave its regulated entities the space to deal with the crisis at hand, told them that individually and announced it publicly, and to allow them to provide services to their customers by APRA focused its priorities away from enforcement priorities during that period, which enabled the banks, insurers and superannuation entities to focus on providing support and continuity of service to retail and business customers at that time. So now we face improved conditions. APRA has returned to its program of regulation, though we still face risks and the possibility of unforeseen events. APRA has released new priorities, including directed to strengthening crisis preparedness. This is an important time. We're very fortunate to hear from Wayne Byres, the Chair of APRA, addressing how APRA continues to respond, to recognise risks and to evolve its priorities and programs in 2021, directed to the strength and resilience of our financial system. I welcome Wayne.
Good afternoon, everyone. Thank you, Gina. I think not even I realised we'd been that busy, but thank you. Good afternoon. Thank you to CEDA for the opportunity to speak today, and also join Melissa and Gina in just acknowledging the Gadigal people as the traditional owners of the land on which we are gathered today, and I pay my respects to their elders past, present and future. I've been Chair of APRA for just on 7 years. I've been with APRA for pretty much the entire journey. And one thing that I think Gina's comments highlighted was that through that time, our operating environment has constantly evolved. Gina gave you the potted history. I'm certainly not going to run through it now, but one thing that if you look through the history of APRA, you see what has been asked of us over time has only really expanded. We get asked to do more. The last year, though, was quite different because the onset of COVID saw our priorities sharply narrow. We paused, as Gina said, a range of policy and supervisory initiatives, so our intention and the industries could prioritise the immediate severe economic and financial impacts of the pandemic on the institutions themselves, but also the customers which they serve. From our perspective, the core tasks that we have of safety and stability were paramount, and as Melissa said in her comments, the strength of the financial system allowed it to play a really important and critical role in supporting the Australian community through a very difficult period. Now, the eruption of a crisis, though, doesn't mean that a whole raft of other issues go away, and now the economic recovery is underway. It is important we start to look a little bit more broadly again. So with that in mind, we did publish a whole raft of new supervisory and policy priorities at the beginning of the year. They cover quite a wide range of issues and activities, and I'm not going to attempt to summarise them all here because I couldn't do them justice, and you can find them on our website if you want to read them at your leisure. What I am going to do today is focus on three important issues that are relevant right across the financial sector and are critical to long-term strength and resilience. We're a financial regulator, but the issues I'm going to talk about are not necessarily thought about, at least immediately, as financial risks. But they are important for the financial system to be able to continue to serve the community. And in talking about these issues, I also want to highlight some new programs of supervision activity that we're piloting. Now, I just want to say up front too, Melissa talked about the survey earlier on. I'm going to talk about three issues. They're not meant to hint what the answer to the survey is. In fact, I'm really interested in what the survey says at the end because I think there's a lot of wisdom in crowds, so it'll be interesting to see if they line up with what I have to say or not. The first issue I want to talk about is climate-related risks. So since the Australian government became party to the Paris Agreement, we've been trying to do our bit to raise awareness of climate-related risks to the financial sector. Now, in many respects, that's been pushing on an open door. The industry as a whole has been increasingly alert to the potential risks of a changing climate, but obviously, given the long-term and unprecedented nature of climate risks, understanding and managing them is easier said than done. the processes, the tools, the data to measure, monitor and manage climate-related financial risks are still developing. There's a deficit of data on how the risks will unfold, in what areas and over what time frame. Added to that, the complexity of financial risks and global supply chains means understanding where and how climate risks will impact on the financial sector is not easy. And if you want a good example of that, think about dust storms in the Suez Canal. I don't think many people were thinking about that as a risk. So against that backdrop, last week we released a draft Prudential practice guide to help financial institutions to better understand and manage the financial risks that flow from climate change. Now, importantly, the guidance doesn't tell banks who to lend to, it doesn't tell insurers what to insure, it doesn't tell super funds where to invest. Those are obviously decisions that are rightly for financial institutions themselves. The draft guide does, though, emphasise that climate considerations need to be part of any decision-making process if financial institutions want to make well-informed decisions. And an improved understanding of the impacts of climate change should equip the financial sector to grasp business opportunities that a changing climate will generate. As new investment is needed, new technologies emerge, and economies and new businesses grow. It's not all about the downside. On the day we released the guidance, journalists asked me what I thought the biggest risk was from a climate perspective, and I said it was that financial institutions might be caught unawares by and unprepared for the changes that are occurring around them. Now, those changes are not just the physical risks of a changing climate, but also, importantly, government policy changes occurring around the world, which are changing, in turn, the dynamics of economies and industries, as well as changing investor demands and changing community expectations. Now, the risks are very real and immediate. After a year of not just COVID, but also devastating bushfires and floods and storms, if you look at the latest CSIRO Bureau of Meteorology State of the Climate report, it's forecasting even more extreme weather events, more heat extremes, more time in drought, more intense rainfall events. The transition risks in climate change are evident in the shifts that are occurring in the value of climate-affected assets. And we've seen an example of the liability risks in the legal action that was launched against the super fund REST, where in order to settle the suit, they had to agree, or they chose to agree, to set a net zero investment strategy and to implement climate risk considerations as part of their management process. Now, thankfully, the boards of financial institutions have the same interest as we do in not being caught unawares, which explains why the impetus for the practice guide that we put out actually came to a large extent from industry requests for clearer guidance on our expectations and examples of better practice. As the Prime Minister said recently, the world's response to climate change is simultaneously reshaping the global economy, global politics, and the global energy system. For our part in Australia, obviously, the government has the technology investment roadmap to accelerate the development of low-emission technologies. Last week's virtual climate summit, hosted by the US, saw a number of jurisdictions announce new plans to cut emissions. The EU is looking at carbon border adjustment mechanisms. New Zealand has introduced into Parliament a law requiring the financial sector to disclose the impact of climate change on businesses, and the UK is consulting on a similar proposal. All of those developments underlie the importance of understanding the significant shifts that are not just underway, but importantly are gathering momentum. And financial institutions need to think about how these actions are going to impact on their businesses and their customers. Now, one of the biggest challenges in doing so is to shift from subjective judgments to data-driven analysis. I think the scientific link between carbon emissions and warming temperatures is pretty clear, but the tools and methods for risk analysis are still in their relative infancy. Not only are the direct impacts difficult to assess, but so are the potential technological and policy responses. But that's not an excuse for not trying. And so a second major plank of our current work program on climate-related financial risks is our pilot climate vulnerability assessment. So we're starting with the 5 largest banks, and we're hoping this assessment will help to measure the potential financial exposures of institutions, the financial system and the economy to climate-related risks, and boost understanding of how institutions might adjust their business models in response to different scenarios. Our goal is to better identify and measure the links between climate science and financial risks within the context of existing industry risk assessment frameworks, because I think without this linkage, climate-related risks can't effectively be considered nor managed by the financial sector. Now, of course, we're not a scientific body, so we face many of the same data and modelling problems as financial institutions. Luckily, Australia does have some world-class scientific bodies, and we are doing some work at present with the CSIRO to see whether it's possible to leverage their expertise in climate change and modelling as part of this climate vulnerability assessment. If we can do that, then when we combine that expertise with the climate scenarios that have been developed for international use by an international group, the Network for Greening the Financial System, then I think we'll have a strong science-based foundation and a degree of international comparability to the analysis, which is very important. Once we have the results, which we hope we'll have later this year, we'll look to see what lessons learned about the overall outcomes can be published and communicated to industry participants, but also anyone else who's interested in the topic. We'll give some thought to how the vulnerability assessment can be expanded to other parts of the financial sector. And clearly we want to make sure that a better understanding of this complex issue is used to help the financial system better manage the risks. So to sum up, our work on climate reflects our preventative Prudential role and mandate. Financial institutions obviously exist to take risks. That's how they earn. And our role is to make sure those risks, from whatever source they are identified, measured, monitored, and most importantly, managed. Climate risks have some unique challenges, but our basic objective is no different. The second area I wanted to talk about today is the set of topics that, at least in the regulatory sector, we shorthand as GCRA. Governance, culture, remuneration and accountability. Now, our work in this area started in many respects just after the global financial crisis. A risk culture, or more correctly, an absence of an adequate risk culture, lay at the heart of the subprime crisis that emanated from the US in 2008. Poorly structured incentives and an absence of accountability for poor outcomes was a recipe for excessive risk-taking that proved very costly for society. The Hayne Royal Commission and our own CBA Prudential inquiry showed that Australia was not immune from some of the issues that had been uncovered elsewhere, and that more needed to be done when it came to culture, incentives and accountability in the financial system. My observation would be that public attention on these sorts of issues has faded a little bit since the Royal Commission. Obviously, I think that partly reflects just the overwhelming nature of COVID, but I think it does also reflect the fact that many banks and insurers and superannuation funds have worked hard to lift their game. And we've also deliberately slowed down some of our work in the last year and reallocated resources to more pressing issues. But although we slowed down our work, we didn't stop it, and we remain of the view that systemic weaknesses in governance, culture, remuneration and accountability are often the root cause of problems that crystallise into significant, unexpected and damaging financial losses. And so with that in mind, I just want to touch on 2 initiatives that demonstrate our ongoing commitment to trying to lift standards in this area across the financial system. The most notable, and often the most emotive, I have to say, is our ongoing work on remuneration. Working on how people are paid is a very sensitive topic. Last year we released for comment an updated standard, Prudential standard on remuneration, and later this week will release for consultation a draft guidance to aid in its implementation. Now, in releasing our updated Prudential standard last year, probably the most significant change that we made was to shift from a more prescriptive approach to a more principles-based approach. And that was done in response to industry feedback that the level of prescription was unnecessary. It created problems for the wide diversity of institutions to which the standard applied, and in some cases it might even be counterproductive. We accepted that argument, or those arguments, but in shifting to a principles-based approach, it's then led to a demand for more guidance on how to turn the principles into practice. And so our draft guidance being released this week is designed to help in that regard, particularly because many boards are actually not sitting and waiting for regulators to move ahead and define what the rules will be, but actually want to get on and make changes to their arrangements now. Now, our work on remuneration is challenging some long-standing conventions, and we're also trialling a new approach to the way in which we examine risk culture in financial institutions. Our traditional engagement with financial institutions occurs primarily through boards and senior executives and risk and compliance personnel. We can form views about an organisation's culture from those engagements, but it's always going to be pretty judgmental. It's going to be less than comprehensive, and it's very difficult to benchmark against different institutions. So to improve on that, we've recently commenced a pilot risk culture survey involving 10 general insurers of various shapes and sizes. The survey is quite similar in concept to the successful Banking Standards Board employee survey that occurs in the UK, and it involves staff in the 10 pilot institutions completing a survey of about 40 odd questions that explore attitudes and behaviours in relation to risk, and the willingness and capacity to speak up when things aren't right. Now, all going well, we plan to use the survey to identify themes across the industry that are impacting on risk culture, as well as particular institutions that we might want to look at a bit more closely. For participants, we hope the survey will help them assess their risk culture maturity over time and relative to peers, identify areas where action is needed, and obviously fulfil their obligations under our standards. But most importantly, we're quite hopeful the survey will actually provide some important evidence of whether all of the efforts in recent years to improve the culture within the industry, both within individual institutions as well as across the financial sector as a whole, are actually having a genuine impact, because that's actually a very important question to answer. And then last, but definitely not least of the topics I want to quickly cover today is cyber risk. Of the three areas that I've covered, cyber presents, I think, the most difficult prudential threat. Unlike issues around culture and unlike climate risks, it's actually driven by malicious and adaptive adversaries who are intent on causing damage. Cyclones and bushfires can obviously be devastating, but they don't do it on purpose. There'll be few organisations that don't have cyber near the top of their risk registers, and certainly high on ours. We put out a new standard in relation to information security and cyber controls in July 2019. The code on the slide is CPS 234. That's the new standard. And in November last year, we unveiled a new cybersecurity strategy which focuses on three key areas. Making sure the financial system establishes a baseline of cyber controls, that boards and executives of financial institutions are equipped to oversee those exposures and direct corrective action where needed, and thirdly, to rectify weak links in the broader financial ecosystem and the supply chain. The financial system is a core piece of economic infrastructure for the country. Its cyber defences are therefore of great importance to everybody. But if you think about the Australian financial system, it is an ecosystem of many, many thousands of entities, markets and infrastructure, not to mention all of the related service providers involved. It's often said the system is only as strong as its weakest link, and of that many, many thousands of institutions and markets and infrastructure and service providers that contribute to the financial sector, we only directly supervise a little over 600 of them. So our new strategy recognises the necessity to work quite closely or very closely with other arms of government if we're going to achieve our objectives. Working collectively to share intelligence, pool resources and respond quickly to plug gaps and fix weak links are essential tactics if we're going to keep adversaries at bay. Given the nature of the issue, we all need to move with speed. So for our part, work is now well underway to finalise a series of independent cybersecurity reviews right across the APRA regulated population. We're almost complete an initial pilot, and based on the learnings from that pilot, we'll follow that up with a 12-month period where all APRA entities will be asked to conduct an independent assessment against CPS 234, the Prudential standard that I mentioned, providing an important baseline level of assurance right across the system. We're also working on more information collection, and perhaps more innovatively, we're also working on a more active cyber defence testing regime in conjunction with our colleagues at the Council of Financial Regulators. So that involves getting specialist expertise to actively probe for gaps and weaknesses in an institution's cyber defences, using the tools and techniques that are actually employed by real-life adversaries. So ethical hacking, in other words. We've got a pilot exercise underway, and we hope that's going to give us valuable insights into not just cyber resilience of the individual institutions that are part of the pilot, but also help us identify systemic weaknesses that may present a risk to the integrity of Australia's financial markets and the financial system more broadly. None of what I've said today should suggest that we are being any less vigilant in the areas that might be regarded as our traditional areas of focus. The financial system has been resilient through COVID because of its underlying financial strength, and evidence from around the world is that strong financial systems have been a major advantage in responding to the crisis. For those reasons, we certainly remain focused on that core financial health as a core part of our job, because it needs to be there when we need it most. But the threats to that health are always evolving, and so we can't stand still. We need to evolve our tools, our methodologies and our practices in response. I've talked today about a few issues that are not necessarily new, but where the risks have certainly come to the forefront in the last few years, and we're adapting our supervisory techniques in response, and as I said, launching a range of pilot projects to try new ways of doing things. And we need the financial system to adapt as well. I think, perhaps to finish, just to note the obvious, that it would be a very cruel irony for a financial institution to come through the deepest economic crisis in a century, only to get caught unprepared for risks that they had ample warning about and should have seen coming. So I'll stop there. Thank you very much, and I'm happy to respond to some questions. Thank you.
Well, we changed the iPad back from being unlocked. I encourage you still to put your questions in to the login ceda.pigeonhole.at and passcode APRA, what I didn't know was the password. But in the meantime, Wayne, I'll ask you the first question, which is that you have covered, and Melissa covered, that it was very critical to stimulate the recovery from COVID to have a robust, strong, resilient financial system which withstood the GFC and stood us well. The question that is now being asked is, are those settings too robust so as to restrain lending and the necessary freedoms and flexibility to turbocharge our economy to come out of that experience, address unemployment and address other aspects that are important to the Council of Financial Regulators as a whole?
So that's a great question, and it is important. And I think we are always trying to make sure the regulatory settings are right and are balanced. You alluded at the start to the fact that we don't have a safety at all costs mandate at APRA. We have a mandate that Parliament has given us that said balance safety with competition and contestability, efficiency, competitive neutrality. We've got a government that has asked us to also think about innovation and those sorts of things. So it is not safety at all costs. It's not designed to be a riskless regime. In fact, you can't have a riskless financial system because, as I said, financial institutions earn their living by taking risks and managing risk well. So we do need to keep those settings in careful watch and make sure that they are not, they're providing the right kind of balance, not being unduly conservative, but obviously not being reckless to a level that the community wouldn't tolerate either. There is, I think, a lot of emerging evidence, and for those of you who bother to print off my speech, which will be on the APRA website afterwards, there's a footnote at the very end that refers to some research that's been conducted that looks at the way in which different countries have emerged from the COVID period and the extent to which strong financial institutions have been a benefit. GDP growth has actually been positively impacted by a strong financial institution, strong financial system. Credit growth has actually held up better in better capitalised financial systems, and better capitalised financial institutions have tended to take more advantage of government support mechanisms than weaker institutions. So it's an important question you raise. I think the evidence thus far, and not just my opinion, but the sort of international evidence suggests there's a lot of benefits from strength. So you don't want to give that up lightly. And of course, the last thing I would probably say is you want to be really confident that there isn't a shock coming tomorrow. And I don't know how you could confidently say that, whatever the next crisis is, I don't know when it will come, but absolutely certain it will come. I've been in this job for a long time. They come regularly.
Your sense is the settings are the right settings for this situation?
Broadly, yes. But I think we, as you alluded to, when the crisis hit, one of the things we tried to do was act in a counter-cyclical fashion. So the deferral program, the release of capital buffers, all of those steps were really saying, at a time of need, we take the pressure off the system.
Yes.
But at some point, you have to build that back up again because you don't want to be caught short next time the crisis comes.
Yes.
It served us well. We saved for a rainy day. We could use some of that when the crisis hit.
The next question is an interesting one. It's asking, has regulation outstripped consumers' capacity, but also the regulated body's capacity to understand the complexity and volume of the information that they're required to provide and the purpose for which it's required to be provided, undermining what APRA as a regulator is trying to achieve?
Yeah, another good question. And quite possibly, the answer to that could quite possibly be yes. Over the years, regulation tends to get just layered and layered and layered rather than necessarily reset, because often that's easy to do things, just incrementally add something without necessarily looking at the totality and saying, have I got it optimally right? The government now has a broader deregulation agenda. They're having a look at, not just in the financial sector, but more broadly, is regulation effective and efficient? It has a deregulation label attached to it, but if you look at what the government is talking, and particularly Minister Morton, who's got carriage of the issue, it's not really a debate about more or less regulation. It's a debate about sort of best practice regulation, efficient regulation. We, for our part, are having a look at a range of issues. You know, do we collect too much data? Do we collect the wrong data? Do we impose requirements on boards that are not really capable, boards are capable of fulfilling given their non-executive role? So we're actively looking at that, and we're looking at the regulatory architecture more generally. So my sort of summary response to the question is it's a good one and it's under active consideration.
Will the survey that you're looking at in the response of employees to risk might feed into that as well as to how they've absorbed it? It
could. The other thing is we do every couple of years, and we're about to launch another one, we do a stakeholder survey of performance of APRA. Do we get it right? Do we add value? Are the issues we highlight as important? Are they the ones that regulated institutions think are the ones that they should be spending their time on? So we'll do another one of those this year. We'll actually launch it quite shortly. So we'll get survey. We're surveying, in a sense, our population, our regulated population, what they think of us. So it'll be useful test, and we will publish the results so everyone can see the answer.
This question asks whether over time economies, and I would add businesses, have become too reliant on credit as the driver of economic growth, and does credit bring forward economic growth that would otherwise over time with saving and reserves develop, or does it create growth that otherwise would not have been able to be achieved?
My personal answer to that is it does both. I mean, it does a bit of both. There's no doubt that, you know, if you look at the current monetary policy settings, what are they encouraged to do? They're encouraging people to borrow, invest, spend. That is the purpose of the policy, and some of that will be dragging consumption and investment forward to now that may have not have otherwise occurred. To the extent it's allowing people to do things because debt is cheaper. You know, they can buy a house, renovate a house, build a factory, whatever it might be. That's the purpose of the policy. Some of that will be brought forward, but you'd like to think that that is also helping activity to generate better economic conditions, not just today, but into the future, and avoid the costs that come from really excessive swings in volatility in economic conditions. So we have been, I think, pretty fortunate in this country, the stability of the business cycle, and there are costs of instability that we're avoiding at the same time. So it's a tricky question. I don't think there's any definitive answer other than, like most things in life, it's probably neither one nor the other. It's somewhere in the middle.
We've got a house price, a very Sydney question. The question is, economists from big banks are forecasting house price growth of 15 to 20% over this year and next. Would such rapid growth prompt APRA to intervene with macro-prudential policies and a reset? And why or why not?
The question that I get asked most frequently this year has been that question. So first of all, I don't think it's a Sydney question. House prices are going up right across the country, and in fact, up until relatively recently, they'd been going up probably more rapidly in many of the regional parts of the country than they had been in Sydney and Melbourne. And that was very different to the cycle we had in 13, 14, 15, when most of the house price acceleration was actually happening in two capital cities around the country. The issue for us is not house prices. And for us, they're a risk factor. They're not an outcome. They're not a goal. I've said this many times, but APRA doesn't have a mandate to set house prices or target a level of house prices. It's an important issue, but if it's a prudential regulator, it's not our job to solve affordability challenges. That's the government deals with those issues. For us, the question is, what's the risk to the financial system, and how could risks in the environment that we're in manifest in risks and instability in the financial system? For the most part, that happens when lending standards become poor, become weak, and there's excessive risk-taking in the system. And as I've said previously, up to now, we don't see that. I think banks have done a pretty good job in holding lending standards up. We did a lot of work a few years ago, which was called our macro-prudential intervention a few years ago, to lift lending standards up. And they've held, by and large, they've held pretty well since then. So the issue for us, to the extent that we have to do anything, would be triggered not by house prices going up X or Y, but rather by what's happening in the financial institutions and what do we see in terms of risk-taking.
Yes. We've got a timely question, I think, from the State Bank of India, which is reflecting that foreign ADIs, but I expect also Australian ADIs, are seeing support for local families from parents who are located overseas and more separated now overseas, and may be more exposed to cyber risk as a result, as they're more reliant upon transfers. And is that something that perhaps, Wayne, is being discussed globally amongst regulators as part of the increased challenges connected to cyber?
Yes, it's a big issue. We see it, certainly in the example talked about there, you see it in, in this part of the world, in Australia and New Zealand, a lot of remittances to the Pacific Island countries and the like are challenged because there is a tension between the banks needing to comply with know your customer requirements and all sorts of things, money laundering requirements, other regulatory requirements, and then the need for sort of speed and low-cost payments. So it is a broader issue. It's been discussed. It's been discussed domestically. It's been discussed. It comes up regularly when we have engagements with the Reserve Bank of New Zealand, because they have a very strong focus on support for the Pacific. And it's certainly being discussed at forums like the Financial Stability Board, the international forums that I get involved in, trying to make sure we get that balance right, and that you don't find that there's a whole lot of the broader society that ends up being unbanked or can't facilitate payments through the financial system where cyber controls are likely to be strongest, and that you don't end up pushing people into a much more risky environment.
Yes. Based on the current number of independent audits done on financial institutions on CPS 234, what is your view of our financial system preparedness against cyber attacks?
I offer this view not so much based on the current independent assessments that have been done, which we're still working through, but just more generally our observations and comparing notes with regulators in other financial institutions, in other jurisdictions, so other financial regulators like ourselves. I think our system holds up pretty well, particularly the core. Our largest institutions can probably match it with most large institutions around the world. So I don't think there's any lack of intent. I don't think there's any lack of... there's certainly no lack of investment. There's big dollars being spent, and there's a lot of time and resources being allocated to the topic. So in that sense, we probably rank pretty well. The challenge comes though, and if you look at the events that have happened recently, the challenge doesn't come from Bank A had a problem because of Bank A's own operations. The problem existed because Bank A was using software from company X, and the problem was with the third-party provider. And we saw in COVID a raft of issues that led to operational disruptions because third-party providers were not as resilient, both from a cyber perspective but also just from an operational perspective. to the disruption that was being caused, the shift to everyone from home, the change to technology that necessitated. And that's why the third plank in our cyber strategy is deliberately focused at the broader ecosystem in the financial system, because much of the legislation and the regulatory framework that exists in Australia, but also most countries around the world, still has the concept that a bank is it's a stone building in the main street, and it's got a safe in the back and a computer in the basement, and that's kind of what a bank is.
Looks a couple of centuries old.
Yeah, it does. It's sort of centuries old, whereas we know, even for the banks that are a couple of centuries old, that's not the way they operate anymore. And we've increasingly got banks entering the system that actually don't have a physical presence, at least shopfront presence. So, and are reliant on all sorts of providers. But if you're a depositor of the bank, actually, you don't really know about any of that. You just think, this is a bank, and my money is safe, and I expect it to be safe. So for us, that bit about... so I think our financial institutions, the attention, the investment, the resources, that's all good. The challenge comes from the reliance on other parties to deliver particular services, and in many cases, those parties are not as resilient as the regulated core.
Wayne, there have been times when our government and regulators have particularly marked the importance of setting their regulatory framework and parameters to encourage innovation. How important do you see innovation is to these aspects of strength and resilience for financial institutions?
Well, I think like most things in life, it can be kind of a double-edged sword. I mean, there'll be innovations that try and fail, and we have to be careful about those, because you don't want the failures to be material and costly and disruptive. But there will be lots of innovations that happen, and we see it in our lives every day, that's actually improving the community's well-being. And it will mean, in a financial sector context, there are new ways of doing things and new technology, which is both more user-friendly, but more importantly, more resilient and reliable than legacy systems that are increasingly antiquated. So, it's hard to say innovation is good or innovation is bad. You have to look at what's happening. You want to make sure that the innovation is allowed to occur. You want to make sure it's allowed to occur in a relatively controlled and orderly way, and that if it proves to be an unsuccessful innovation, it doesn't cause too much disruption. For our part, we've tried to think about it, for example, in the way we're licensing neobanks. And we changed our licensing framework a couple of years ago to allow it easier for small startups to become banks, and we've got a pipeline of applicants, and some who've come through and graduated, and some who came through and proved to be unsuccessful, not a viable business, and they've exited. But it's all happened in a very orderly way, and so we see that as the important role we're playing in allowing and encouraging innovation and new business models and the so-called neobanks, different offerings to customers, but in a way that still says this is a bank. The community, doesn't expect a different level of safety. If they've got a deposit in a bank, they expect it to be safe, and we have to still make sure we can deliver on that.
And that process of those banks entering, one of the questions here is asked, that process of those banks entering, some failing, others being acquired, others continuing, is the path you would expect to see with innovation and the regulatory framework?
Yeah, I mean, I sort of... so there was a case that's well known, Zinger Bank, which was one of the banks that came in relatively early on in that process, and it's now exited. I described that as a successful failure in the sense that they came in, they tried, they exited, didn't work, they exited. the depositors got their money. It was all very orderly. You took, and the system carried on without any sense of disruption or stress or contagion. So that, maybe they had a good offering, maybe they didn't. No one knows up front. You've got to try. And we've got a number that are in the pipeline now. I guarantee not all of them will be successful, but part of our process is to make sure that if they're not going to be successful, as I said, we can have an orderly exit, a dignified exit from the industry, not something that's disruptive or jeopardises the confidence in the system.
The final question that is here that links from your description of the pilot risk culture survey, in the learnings that you get from that will then feed in to the way in which you set the standards and the guidance that you're proposing to give, both for the insurers but more broadly.
Yeah, so for us, I don't envisage we will have a lot more. I'm wary of how much you can attempt to regulate something like culture. I think that's not going to be a successful recipe, a successful way forward. So the way we have approached this whole issue is, through the Royal Commission, other things. The financial system clearly didn't have a culture within it, or at least parts of the financial system didn't have a culture in it that the community was accepting of and happy. And we got, as a result of the Royal Commission, we got a number of recommendations from the Royal Commission. The government endorsed them to try and do some things to improve that situation. As I said, there's a limit to what you can do, though, through regulation. The way we've tried to think about it is, how do you actually better equip boards to do their job? Because they and the senior executive have the role to play in trying to set the tone from the top, establish what the culture of the organisation should be, establish the right kind of behaviours, establish the right kind of incentives for people so they're not incentivised to do the wrong thing, and apply the accountability mechanisms at the other end of the spectrum when things have either gone right or wrong. So as much as anything, it's about equipping boards to do that, to play that very important role they play in governing the organisation. So it's less about rules from us, it's more about thinking about what sort of information can you helpfully provide boards. We have a vantage point that few people have in our capacity to compare, contrast, benchmark and provide boards with peer comparisons that they mightn't otherwise be able to see. So, as I said, it's about equipping boards primarily to do their job rather than trying to regulate a good culture into existence. I don't think that's going to work for anybody.
I'd like to thank everyone for all the questions that were submitted, and Wayne for engaging with them in such a thoughtful way, and to invite Melissa back. I think she wants that for the poll.
Thank you very much. Thank you again to Wayne for sharing your insights and for your openness and clarity in answering today's audience questions. The discussion today touched on several of the risks and opportunities APRA and the financial system will be tackling over the recovery period and beyond. And like APRA, the CEDA research team are also focusing on the critical issues that will shape our long-term economic and social development. In particular, the challenges that came up in today's discussion around governance, culture, and appropriate risk-taking are also challenges that apply to the business community more broadly. At CEDA, we are taking a closer look at the risk culture and management capabilities of Australian businesses as part of our research program on business dynamism and competitiveness. If you would like to know more about any of the research programs, I'd encourage you to have a look at our CEDA website. Now, I can now share with you the results of today's poll question, which was, what are the biggest risks to the resilience of the Australian financial sector over the year ahead? And Wayne, you said you were looking forward to these results. So you'd be interested to know that the number one risk identified by people in the room and in the live stream today was cyber attacks and other technology risks at 55.6% of respondents. And coming in second at 25.9% was housing price growth and excessive household debt. Thanks to everybody who contributed to today's poll. To bring things to a close, I'd like to say thank you again to Gina, Cass-Gottlieb, and to Gilbert and Tobin for your support and assistance with today's event. Thank you also to everyone for participating, both in person and via the CEDA live stream. Do keep a lookout for a post-event email, which will include the complete poll results as well as a link to today's live stream recording. If you enjoyed today's discussion, then please look out for details of upcoming CEDA events. Here in Sydney, we're delighted to have confirmed New South Wales Treasurer Perrottet for his post-budget address that will take place on the 23rd of June. And continuing our focus on economic recovery, we also have events in the pipeline for June on the New South Wales Intergenerational Report, a half-year economic assessment, as well as a discussion with Productivity Commission Chair Michael Brennan. So do look out for invitations to those events in your inbox. For now, thank you very much for your attendance and participation, and have a good afternoon.